Explain the difference between a tracking stock and an MLP, a master limited partnership. A tracking stock is an equity issue that represents an interest in the earnings of a division of a company. In a scenario where a conglomerate acquires other firms, but its combined entity sells at a discount, it can try to boost the stock by allowing one or more divisions to trade separately as a tracking stock. These shares issued pay a dividend determined by the performance of the specific portion of the company. It is generally a class or series of common stock of the issuing corporation. So a corporation can have Class A shares, which represent, 4 of the 5 subsidiaries, whereas the Class B stock would be a tracking stock, and it would track the sole subsidiary that was not accounted for in the other shares. Now, tracking stocks do not represent or require any change in business structure. Holders of tracking stocks are considered to hold equity in the parent company and not the specific entity represented by the tracking stock. Payment is subject to the risk of the operations of the issuer as a whole. Now, consider the newly created tracking stock for VMware that will be issued by Dell as part of its $58 billion deal to buy EMC in 2016. Now, this deal, to finance that deal, they issued these stocks, this tracking stock, in order to raise money, which at this time, on July 24th, 2017, the raise was priced in the market at $12.87 billion US dollars. So they raised quite a bit of money to help finance that deal. And so the tracking stock tracks the performance of VMware, not Dell and the overall performance of the company, but rather this specific division of the company. And so not only does this help raise funds, but at the same time, it tracks a specific segment of the company. And so when we talk about, the breakup value exceeds the combined value of the entity, well, tracking stocks help really divide up those subsidiaries so you can realize the full valuation of a big company like Dell. Now, on paper, the new class of stock, whose value is tied to a large part of Dell's investment in data center technology company VMware, will help raise funds to finance the EMC deal, as I said. But the tracking stock gives holders no ownership of any underlying business or assets and few rights. It just trades based on the earnings of the underlying asset VMware. Not a lot of demand for such a tracking stock, and that's why you don't see a lot of them. But at the same time, it is an opportunity to raise money if you do read the market well and determine that if you raise $1 billion to the issue of a tracking stock for your respective company and there's enough people to demand it, well, then that's a profitable idea, and it's a very smart way to really strategize and overall maximize the value of your company. On the other hand, a master limited partnership, an MLP, are limited partnerships in which the shares are publicly traded. The general partner, the GP, runs the daily operations, while the limited partners, the LPs, collect the income generated by the respective asset or division. The key advantage to this structure is the elimination of the corporate layer of taxation. Stockholders in a corporation are taxed twice, once at the corporate level and once when dividends are distributed. Now, if you don't understand that, let me explain it this way. When Apple, or say for example, you have a company that pays a dividend. Now, when the company earns that money initially, as a corporation, they pay tax, right? That's what you see on their income statement, the tax expense. They pay tax. And then out of that net income after tax, they then take that and distribute it X amount percent as dividends to their shareholders. Now, when the shareholders receive those dividends, they also pay a capital gains tax on that, an income tax on that, right? So what happens is that there's a double taxation from the entry of that $1 to when the dollar hits the shareholder's bank account. With the MLP, you eliminate that. So there's no more taxation at the corporate level, and it flows through only to the shareholders level. The returns instead flow through to the owners, who only pay their marginal tax rate. The MLP has been used to redistribute assets so their returns are not double taxed. In a common rollout MLP, the corporation transfers assets and gives units of ownership to existing shareholders. The income generated by this division in the MLP is then taxed only once, thus improving the after-tax cash returns for the owners. The main disadvantage, however, is that the general partner who runs the division bears unlimited liability. In a corporation, the owners are insulated from the company's liabilities, which ensures that during bankruptcy, creditors cannot come after your personal assets. So while there is a tax advantage for LPs, the general partner, the GP, or the company itself who runs the division and puts itself at risk, right? So for the company, if that respective MLP goes bankrupt, those assets, they have either a huge upcoming litigation cost that will really bankrupt the entire company. Well, they can't really hide from their personal assets because they will be responsible to pay every dollar back, seeing that they bear unlimited liability. Whereas with corporations, you can go into bankruptcy and then rid yourself of those liabilities. So the trade-off oftentimes does not make a lot of sense in the long term when you consider that the GP is the primary incentive. They're the guys running it, whereas the LPs are just collecting the money. So if the GP is not on board, then the LPs are just never going to get this type of structure. In addition, a disadvantage for LPs is that they do not have control in an MLP agreement. So for activists or institutional investors who want to influence the management of the asset, there are no voting rights tied to the LP units. And especially for institutional investors, they're always interested in getting involved in the company, right? Interested in really representing their ownership stake. And if the entire company is publicly listed through an MLP, well, what happens is that institutional demand is not going to be very high because institutional investors know that they're not going to have any voting rights if they acquire these LP units. For retail investors, it's not so much, especially if you own 0.0001% of a company. But if you own 20-30% of a company, you've put your money where your mouth is. You want to make sure that you have a voice in how the entire company is run. And through an MLP, you can't do that. So that's the big disadvantage for LPs, whereas with GPs, the big disadvantage is the unlimited liability.